Welcome to the Level 1 Financial Reporting and Analysis Summary video series. This video is a summary of the reading on income taxes. The first point to understand is that there is a difference between accounting profit and tax income. So your financial statements follow different rules, the tax statements follow different rules. Financial statements are prepared based on accounting standards. These standards define the rules for computing accounting profit and hence the tax expense. The calculation of tax payable is based on tax laws, and it is the difference between income tax expense calculated on the financial statements and income tax payable calculated on the tax returns which results in deferred tax assets or deferred tax liabilities. In fact, it's the temporary differences that result in DTA and DTL. Just to give you a sense for why there are differences, with accounting we generally use straight line depreciation, with tax we generally use accelerated depreciation. With accounting we have certain revenue recognition rules, we have the concept of the matching principle, whereas on the tax side generally revenue is based on cash received and generally expenses are also based on cash paid. So clearly the rules are different, and since the rules are different, that's why the income tax expense and income tax payable will be different. This, I would say, is the most important slide from the reading, so make sure you know everything on this slide. Deferred tax liabilities arise when the income tax expense is temporarily greater than income tax payable. And why might this happen? One reason is where the revenue is recognized on the income statement before being included on the tax return. So when can this happen? When we do a credit sale, for example. So if we do a credit sale, then the tax authority is not taxing us because we've not received the money, but our income tax expense is high because on the income statement we are showing higher revenue, therefore higher profit, therefore higher tax. The other scenario is where expenses are deductible before being recognized on the income statement. So when is an expense deductible? If you have accelerated depreciation, then on the tax reporting side you will have a very high deductible expense, whereas if you are using straight line on the financial statement you will have a relatively low deductible on the financial reporting side. A deferred tax asset arises when we have the opposite situation, so income tax expense is less than income tax payable. This can happen if revenue is taxable before being recognized on the income statement. So if you have unearned revenue, you received the cash, tax authority says you've got the money, pay tax, but on the financial reporting side it's still unearned revenue, so it's not shown as revenue, so you don't have the corresponding earnings. Or when expense is recognized before being tax deductible. So when you show a warranty expense, for example, the warranty expense reduces your income tax expense, but until you actually make the warranty expense payments, you cannot deduct it for tax reasons. You need to know the concept of the asset tax base. This is the value of an asset according to tax rules, and this is analogous to carrying amount on the financial reporting side. On the financial reporting side, if you start with an asset at 100 and you have depreciation of 20, then you will come down to 80. On the tax side, if you start with 100 and through accelerated depreciation you depreciate 40, then the tax base comes down to 60. Notice it's the difference between the carrying value on the financial statement and the tax base on the tax documents. It's that difference which creates deferred tax assets and liabilities. And specifically the relationship is shown here. This is the formula you should memorize. The deferred tax liability is the carrying amount minus the tax base. In my example that would be 20 multiplied by the tax rate. So if the tax rate is 40% and over here the difference is 20, then the deferred tax liability created is 20 into 40%, which is 8. So that's the DTL. If the tax base is higher than the carrying value, then you will create a deferred tax asset. What is the link between income tax expense and income tax payable? For a given period, the income tax expense is equal to the income tax payable plus the change in deferred tax liability. So this is the end of period deferred tax liability minus the beginning of period deferred tax liability minus the change in DTA. So sometimes you might just be given a net DTL, which at any point in time is the DTL minus the DTA. So there you will see the relationship ITP, income tax payable, plus change in net deferred tax liability. Changes in tax rates and temporary and permanent differences. If there is a decrease in the tax rate, this reduces deferred tax liabilities and deferred tax assets. If there is an increase in the tax rates, then that increases the deferred tax liabilities and deferred tax assets. Remember that these deferred tax assets and liabilities are created if there is a temporary difference between what's on the financial statements and what's on the balance sheet. Permanent differences are differences between tax and financial reporting of revenue that will not be reversed at some future date. These differences do not give rise to DTLs and DTAs. Examples include income or expense items not allowed by tax legislation, tax credits for some expenditures that directly reduce taxes. When you have a permanent difference between what's on your financial statements and what's on your tax statements, then the effective tax rate will not be the same as the statutory tax rate. The statutory tax rate is the rate announced by the government, so this might say be 35%. The effective tax rate is the income tax expense divided by pre-tax income. Notice that the effective tax rate is purely based on the income statement. So you look at the income statement, you look at the income tax expense, and you divide that by the pre-tax income also from the income statement. Measurement of DTA and valuation allowance. If DTA will not be realized because of insufficient future taxable income to recover the tax asset, then DTA must be reduced. If you think about DTA, this is telling you that sometime in the future you will pay less taxes, and since that is a benefit, you are showing it as an asset. But let's say that you will not make money in the future. So if you are not making money, then you do not get any benefit from the fact that you will be paying less taxes. If that is the case, then you have to reduce your deferred tax assets. In US GAAP, that is done through a valuation allowance, which is like a contra account. Just like depreciation is an expense or a contra account that reduces the value of equipment, similarly, valuation allowance is a contra account that reduces the value of DTA. This little example illustrates the point. You have a company in 2012, the company discloses DTA of 10, and at that point the valuation allowance is 10. In 2011, the year before, the company disclosed a valuation allowance of 15 against a DTA of 95. So what happened between 2011 and 2012? The point is that the valuation allowance in 2012 actually came. So the valuation, what was the valuation allowance in 2011? In 2011, the valuation allowance was 15. Now the valuation allowance has gone down to 10. So what happened to the DTA? The DTA actually increased. So that means that expectations of future earnings power has increased. It's more likely that the company will make money, so it can reduce the DTA. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.